Good afternoon, ladies and gentlemen, and welcome to the CC Japan Income and Growth Trust PLC investor presentation. Throughout today's recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time just using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. Before we begin, we'd like to submit the following poll, and I'm sure that the Trust will be most grateful for your participation. And I'd now like to hand over to Nicholas Todd, Investor Relations from Frostro. Nicholas, good afternoon.
Good afternoon, everyone, and thank you for joining us. Thank you for the introduction, Mark. Today, as Mark said, you'll be hearing from Theo Wild at CCJI, so CC Japan Income and Growth Trust, PLC. Today, we have Theo, one of the portfolio managers and analysts at Chikara Investments, which is the investment team behind the management of the trust. He's going to provide an update, a short introduction for those newer to the trust, and also an update for those more familiar with the strategy. Before I hand over to Theo, just as a brief intro, it's recently celebrated its 10-year anniversary, and since its launch in December 2015 to the end of the most recent financial year ending October 2025, it's comfortably outperformed the TOPIX index and led the peer group over a number of time periods over that time. It's provided shareholders with a growing dividend that has risen since inception continuously. Markets have faced a pretty unsettling time over the past couple of weeks. However, the underlying fundamentals and the opportunity that lie ahead for the trust and the managers and the strategy are undeniable. And without further ado, I think I'll hand over to Theo so he can provide you with that insight.
Great. Thanks, Nicholas. And good afternoon, everyone. Thank you for taking the time to listen in about CCJI or CC Japan Income and Growth Trust PLC. So first and foremost, who we are. So there are three of us on the investment team here at Chikara. Richard Aston, you'll see his profile on the far left. Richard has been covering Japan since 1997 and joined Chikara in just after the GFC. He is the origin of the strategy, and he has been the lead manager of the trust and the open-ended vehicle since their launch, which, as Nicholas said, is over 10 years ago. Next, Megumi Takayama. Megumi joined Chikara in 2018. She, in fact, had a sell-side relationship with Richard, so was known to him prior to that. And as I said, joined the team in 2018 and has been a stalwart ever since. I'm the newest member of the investment team. I joined Chikara around 18 months ago. Prior to that, I was working on the Japan fund at Ruffer for around 6 years, where I was an analyst to begin with, and then one of the co-fund managers of the strategy. And as Nicholas mentioned, and as you can see from our titles, all three of us work as both analysts and portfolio managers. And I'll come on to later on why we think that is a good way of doing things in a team such as ours. So as Nicholas alluded to, CCJI, so CC Japan Income and Growth, is over 10 years old now. And so what we wanted to do was give you a little bit of a reminder of the origin story of the strategy. What is it exactly that we're trying to achieve? And then, as is much more important, to take you through the case why we think the next 10 years is in fact even more exciting than the prior 10 before it. So what do we do? So our aim is to invest in financially sound, and by that we mean cash flow generative, strong balance sheets kind of companies. They need to be growing businesses, that is key. And they also need to be making meaningful returns to shareholders. So we want each and every holding that we invest in to portray all of those attributes. So financial sound, growing businesses, making meaningful returns to shareholders. And what we hope that results in, and in fact, we're proud to say over the last 10 years, this has been the case, is a portfolio that generates a strong total return. So both capital growth, but importantly, compounded by rising dividend growth, and that we're aiming to do that throughout market conditions. Now, of course, this is a fully invested equity vehicle. So this is not claiming to be anything sort of all weather in that sense, but we are trying to stick to our guns and be consistent throughout varied market conditions in the equity market. And indeed, we believe we've managed to do that. And hopefully I'll be able to convince you with the evidence later on in the presentation. So this is probably the one chart that if you had to remember just one, this is probably the one, the most important. So this is really the main reason that Richard decided to launch this strategy, and indeed when he did it. So if we look at the left-hand chart first, the darker blue of the blue lines is cash flow generated by Japanese companies. The lighter blue line, the below line, is cash flow invested, or capex, by those same Japanese companies. And if you look to the sort of far left on the x-axis, that starts around 1970, but in fact, the shape of it is very similar from all the way from post-World War. Those two lines effectively track each other as we go up and to the right. What that means is that essentially Japanese companies were reinvesting all of the cash flow that they generated each and every year. And then if we look to around the very beginning of the 1990s, where the light blue line in fact pokes above the dark blue line, that is actually I suppose a symptom and also evidence of the bubble, the famous real estate, but sort of in general bubble that Japan went through in 89, 90, where, as you can see, the cash flow invested actually exceeded cash flow generated, implying high levels of debt, etc. So then you can see quickly that in the aftermath of the bubble bursting, those lines started to move in different directions. And that is what essentially got Richard interested. And in the early 2000s, you can see that actually that spread, so the spread between cash flow generated and cash flow spent, started to widen considerably. And actually the launch of the strategy is marked by the left hand of the two red arrows. So what did that mean? Well, that essentially meant that, of course, the dark blue line moving up and to the right shows improving cash flow generation from corporate Japan, but also the light blue line actually trending slightly down or to the right implies that the Japanese companies are allocating capital more responsibly. They're thinking more carefully about where to spend, and they're being more thrifty in the outset. So what does that mean? Well, that means the spread is effectively excess cash. It's cash which companies are not reinvesting and they can do with what they like. And if you look to the right-hand chart, you can see that one of the main recipients of that excess cash flow has been shareholders. So shareholder returns in the form of dividends, which is the darker of the stacked bar chart, and in fact buybacks as well, which is the lighter blue line. So you can see really that that exponential growth in dividends and buybacks has come as a direct consequence of the excess cash that Japan is now generating. Prior to this dynamic, Japan was an extremely difficult place to invest. The aftermath of the bubble left 30 years of deflation, which we'll come on to, but also the TOPIX top to bottom fell around 80%, 80. The similar thing happened in real estate. So it really was a tough place, or an impossible place almost, to be a buy and hold investor. You had to be lucky, you had to catch rallies, and you had to remind yourself to sell at the top of said rallies. Easier said than done. So this real divergence, the key really is that it has allowed the buy and hold investor to invest successfully in Japan. And that is indeed what we advocate and have, I think, proven out with the decade or more of track record ever since. But from your point of view, and from ours as investors, the next decade is more important. So I'm going to talk to you about why we think that really that the stars are aligning for Japan, and that indeed why CCJI is a good long-term solution, or a good long-term way of taking advantage of the structural changes going on in Japan. So we'll start with macro. So this chart here has on the right-hand axis, and the light blue line is the 10-year Japanese government bond yield. And the dark line in the left-hand axis is headline CPI, or inflation. Now, this is the 10-year chart, so the life of the trust. If we were to extend the x-axis back 20 more years, 20, 30 years, in fact, deflation has been, I guess, embedded in Japan for such a long time. And that has really created a mindset of there's no opportunity cost of capital and many other consequences of which we'll get into detail of later. But another one of that is that it's been negative interest rates, or indeed just marginally positive. You can see that huge inflection in both inflation and the government bond yield on this chart in front of you. And we cannot underestimate how big a change this is for Japan as a whole, both in terms of corporate Japan and also the men and women on the street there. It really is a sea change in conditions, and I'll come on to why we believe we're able to take advantage of such changes. Now, we're thinking about the currency. So again, this is the 10 years, the life of the trust. We've got the US and the pound versus the yen exchange rates. Essentially, you can see that during the life of the trust, there have been some periods of yen strength, but the overwhelming trend has been the yen weakening. This has been a headwind, especially for international investors, as they are buying yen assets and then converting those profits back into GBP or USD when they sell, I suppose, shares in the trust or any other Japanese yen asset. So this has been a bit of a headwind. But the main thing I want to sort of mention here, because we do not invest on currency forecasts, is that when you're a corporate, stability of currency is almost more important than any trend. You want to be secure in the investments that you're making in your own business, capital that you're putting to work. And so what we feel is that the outlook for at least a stable, if not appreciating yen is a positive one for corporate Japan. So again, this has been another headwind over the life of the trust, despite the fact that the performance has actually been very good for corporate Japan. Market conditions. So the participants, what this chart shows here is the cumulative foreign flows. So this is foreign investors buying into Japanese equities or Japanese assets. And these are the zero is the beginning of 2012, or when Abenomics, Shinzo Abe came in, and we'll come on to him later on. So you can see this initial large surge of buying from foreigners into Japanese assets, peaking in January 15. And this is cumulative, not week on week. So you can see quite the scale of buying that there was. And then you can also see that until very recently, there's been pretty relentless selling from foreign investors. Now that has clearly been a headwind for Japanese equities, with a large seller in the market, and so consistently for 8 of those 10 years or so. However, you can see lately there's been some foreign buying, and I'm sure we'll get on to the political situation in Japan at the moment, but foreigners are taking a much more constructive view of Japan. We hope they're looking, I guess, through the same lens that we've been looking through for some time now. But it is encouraging to see that foreign investors are indeed buying the market of late. And another thing I wanted to mention is that actually across the same time frame, the domestic retail investor, so the Japanese man and women at home, they have been pretty relentless sellers into any foreign buying. So what we've had is, foreigners since 2015 selling the market, and that's been accentuated by any periods when they have got excited, the domestic investor has been selling too. So the flows have been very, very negative. The marginal buyer has been the corporates themselves. But what this means going forward is not only do we think that foreign investors are being more constructive, that the domestic investors too are also starting to invest. And this is a consequence of inflation. When you've had 30 years of deflation, it made sense for you actually to leave money under the mattress, or indeed to put it into a zero interest rate banking deposit. There was no opportunity cost, in the sense that it was deflationary. It was an appreciating asset sitting in zero. However, that is massively changed. As I showed you in the previous chart, inflation is back, and it has embedded itself. So the mindset of the Japanese investor is changing. It will change slowly, but it is changing. And they're understanding that they need to invest or risk a devaluing of their cash and deposits. And there is, we know of, sort of 10 to 14 trillion US dollars sitting on zero interest rate deposits in Japan. We're seeing a trickle of that come into the equity market, but it's a big change from a consistent trickle out to a consistent trickle in. And we have every reason to believe that trickle will continue and could even turn into a river of flows, we would hope. So we've also got valuation of the equity market to consider. For a very long time post-bubble, Japan traded at pretty crazy, lofty valuations, 50 times earnings, 60 times earnings. But it wasn't until sort of 2012, 2013, as you can see on this chart, that the valuation of the Japanese market, which by the way is represented with the light blue line, started to be in the same ballpark, or indeed at a discount to the darker blue line, which is the MSCI or world or global equities. And that was one of the reasons that Richard launched when he launched. The cash flow story was there, the shareholder return story was there, but there's no use overpaying. So when this, I guess, historic premium unwound, the stars aligned for the launch of the trust. Now, as you can see, there has been a recent appreciation in the Japanese equity market. The discount is now narrower than it has been. But what I would argue is that it's not much more expensive than it was 10, 12 years ago. But the return on equity of the market has gone from 6 to over 9. The attitudes towards shareholder returns, and indeed just shareholders, due to the corporate governance revolution, is as strong as it's ever been in Japan. And actually, over this time period, I think it's important to note that the strong performance in the Japanese equity market has barely come through any upward re-rating. It's been earnings growth. And that earnings growth has happened despite those headwinds that I spoke of in terms of negative interest rates, a steadily depreciating yen, deflation, etc. So we think, looking forward, where many of those headwinds are now tailwinds, corporate Japan is in an excellent position, and we would argue doesn't look overly expensive at all. So another point to make here really is that, if you remember the quite exponential chart of shareholder returns that was on the cash flow slide, you might be forgiven for saying, oh, well, we've missed it. That's it really for shareholder return growth. And this slide, I hope, will convince you of, in fact, the exact opposite. So the left-hand chart, that shows the percentage of listed companies in Japan, well, Japan is the far left of that chart, with net cash. And the two bars are 2016, which is darker compared to today, which is a bit more sort of, I suppose, speckled. And basically, the point is that despite how much cash has been returned to shareholders since 2016, it has still been building up on Japanese balance sheets. And still nearly 60% of listed companies have net cash balance sheets. And as you can see, that is much higher than other comparative developed markets. So you are buying a balance sheet buffer is the way I like to think of it. You can either think of the cash as incremental upside as it gets returned to shareholders, or you can think of it as downside protection. Both are positive ways of viewing corporate Japan and its just general balance sheet resilience. And then the right-hand side, this shows the payout ratio of Japan, which is the bottom of the three. We've got US and Europe, US being the darker of the two. And the point here being that payout ratios, so that's the proportion of your earnings that you pay out in dividends, has also got some way to go to catch up with developed peers. So you have both an income statement improvement for shareholder returns likely, and a balance sheet improvement and or backstop. So not only are you paying a discount to global markets to buy Japan, you've also got the income statement and the balance sheet on your side. Corporate governance. Now, the corporate governance story has been, I suppose, it's been in the headlines a lot over the last couple of years, and that is absolutely valid. And Japan deserves all of the kind of plaudits it is getting for its improvement in corporate governance. But what I'd like to say about that is that this has been a long time in the pipeline. So from really prior to Shinzo Abe taking power in 2012, there has been a very coordinated, concerted effort from the Japanese government, the Bank of Japan, the Ministry of Trade, Financial Services Agency, you name it, Tokyo Stock Exchange. Everyone has been pulling together to improve corporate governance in Japan. And the incremental progress has been consistent. So although we're only hearing a bit about it now, that may be just because it's hit escape velocity in terms of how foreign investors are looking at it, but the improvements have been very steady and consistent. Now, the Tokyo Stock Exchange president recently said that he thinks they're only 15 to 20% of the way through the corporate governance story in Japan. Now, it's very hard to put numbers on these things, but we certainly agree with the order of magnitude. So again, the point here is that you haven't missed it. There is a lot more that Japan can do to improve the corporate governance outlook. And we think the equity market will be a key beneficiary of that. And if I just give you one example, the Corporate Governance Code is having a few new revisions put in later on this year, and one of which is specifically to look at cash on the balance sheet that I just spoke about on the prior slide. It's previously been used as, rainy day funds, be that for natural disasters or indeed COVID or what have you. But there are many companies sitting on more cash than they need, and the attitude is changing, and the Tokyo Stock Exchange is encouraging said change in attitude. So we can hopefully expect many companies to start to return some of that excess cash to shareholders going forward, as it gets enshrined into the Corporate Governance Code later this year. So with all that, that's all very good for Japan, but why should CCJI be your chosen vehicle? So I'll take you through each point. So I guess the first one is that, as I've mentioned, Richard, having covered Japan for nigh on 30 years, it wasn't until, 2013, when the open-ended version of the strategy was launched, that he felt comfortable that he had found the right vehicle to launch in Japan. So this was designed specifically to take advantage of what was going on in the Japanese equity market, and indeed what is still going on today. So this isn't a global strategy that has been grandfathered in and sort of coerced and crowbarred in to work in Japan. This has been designed from the bottom up, from the start, to benefit from what is going on in corporate Japan. And as I've said, we believe all of those factors that it was set up to take advantage of are as strong, if not stronger, than it was 10 years ago. Secondly, we're a small team. I mentioned the three of us in the investment team on the front page, and that we're all portfolio managers and analysts. And we think that's really important. We're also generalists. So all of us are across, all of the stocks in the portfolio at any one time. Of course, that doesn't mean we're all duplicating the same work, but the point being that we're all able to properly delve into each other's ideas and push back. It's often the case in larger teams that the lead analyst has just a huge knowledge gap compared to someone who is playing devil's advocate, that it's not a fair fight. We intend to keep it a fair fight, such that we can actually really poke holes in each other's arguments and keep each other honest in our decision making. Another really important aspect of being a generalist is, if you're a portfolio manager, you need to be able to make decisions objectively between the relative upside or risk reward of, let's say, a healthcare stock versus an industrial versus a tech stock. And being a generalist allows you to better be placed to do that. If you are sector specialists, you tend to get tunnel vision, or at least you can't see the wood for the trees when trying to compare such an idea with one in a completely different sector. And it also allows us to be, truly active, which I'll come on to in the next point. We can and do express our views with zero weights in certain sectors or industries or end markets. That is much easier to do when we're a small team, we are agile, we're generalist, we don't have a large team of competing sector specialists all pushing their ideas at the same time. So we believe there are many, many ways to run money, and this is not to say that the way that any other team does it isn't right, but for the three of us, this is how it works, and we believe that there are many benefits as such. So I also mentioned we are truly long-term and active. I'll show you some data later on both the long-termism and the activism, or I should say active investing, not activism, that we establish later on. But we believe, we are benchmark agnostic. We are concentrated, so with a maximum of 40 holdings. Historically, it's been in the high 30s. We want every investment to count. And we are also importantly all cap. We believe there are a huge amount of exciting examples of potential investments in mid and small cap Japan. And it's an excellent hunting ground for active investors such as ourselves. I also, slightly misspoke saying activism. We are not an activist strategy. We build constructive relationships with our investee companies over time. So we tend to invest for around 5 years, and we become a trusted confidant, but we do not agitate for change. We want to build constructive relationships. We want to be confidants. We believe that is the way to do things best, especially with the cultural sensitivities of Japan, but also in order to remain trusted for a long time to come, as we intend to be investing in Japan for many, many more years yet. Point 4, we utilize gearing. So the trust is structurally geared, and by that I mean it has to date been 20% geared throughout its life. Never say never, but the board and with a bit of input from us are constantly assessing the gearing level. But what we wanted when it was launched was to create something very simple and to not try and play around with gearing in the sense that it requires market timing. We know we're not market timers. We would rather use the gearing as a way of bolstering the structural growth story that we see in Japan. And indeed, the gearing has been a very considerable contributor to returns over the last decade. I should say a few more things about the gearing, one of which is that not only does it boost the capital growth, as I've mentioned, we are also entitled to the dividends on the contracts for difference that we use for gearing. And what that means essentially is that it's a boost to the dividend yield of the trust in the short term as well. So another benefit there. We have a decade of track record, speaks for itself, and I'll go into the performance later, and hopefully I can evidence the fact that the trust has performed well throughout varied market conditions. Consistency is key. Consistency is a key message we want to get across today. That is what we're trying to do. We want our investors to buy, to hold, to know what they own, know it won't change, and benefit from this structural growth story in Japan. And I think the final point, so we are not equivalent to a barbell of growth and value. Sometimes given the name of the trust, income and growth, we are, I suppose, mislabeled slightly as a trust that may have some holdings that are typically more income or value oriented, balanced with some, more growth orientated businesses. This is to say that is not what we're trying to do. We want the income, the growth, and the financial soundness to be present in each and every one of our holdings. So we are not trying to do a delicate balance. And we believe that has a couple of main advantages to that. One of which is that the growth requirements and being stringent about that, they do tend to help you avoid value traps, of which there are many in all markets, but in particular in Japan, it's easy to get sucked in by ostensibly cheap companies, but they may be value destroying companies and often are in most cases. And then on the shareholder return requirements side, if we are requiring the portfolio to yield meaningfully more than the benchmark over time, that in and of itself is a strict valuation discipline. So we cannot own a bunch of non-yielding, loss-making tech companies for fear of violating our shareholder return requirements. So it's a valuation discipline, it's a consistency thing, and it also helps us avoid falling foul of value traps. So I'm going to go into only high level, but a little bit about the kind of companies we're looking to own. So you'll see firstly that cash flow, valuation, and governance, core tenets of launching the strategy in Japan, are indeed core tenets of how we look at individual companies themselves. So the way I think of it is that if you're looking for, let's say you're looking for growth companies that have strong balance sheets. What does that mean? Well, that means that you're looking for companies that are able to grow, they're generating enough cash to grow themselves without resorting to external capital like excessive levels of debt or indeed raising equity to do so. So that is a sign of a good company, a company that's generating enough cash to grow itself. Then if you further restrict what you're looking for to a subset of those companies that are actually generating more cash than they require to grow and are therefore returning some of that excess cash through shareholder returns, dividends, buybacks, then we think that's a sign of an even better subset of companies. So that's how we think about these things. And if anything, it's a quality bias more than anything. We want companies that are kicking off more cash than they require to continue to grow and are therefore complementing that capital return with rising dividends. So how do we find them? 4,000 listed companies in Japan and 3 people. That's quite the ratio. So of course we lean heavily on screening. As you can see here, the top layer of the pyramid being the whole universe, we take out, in one foul swoop, nearly 3/4 of that through a kind of, think of it as sort of minimum standard screen. So as I mentioned, we're looking for companies with strong balance sheets, returning and growth. So we have very low hurdles, but once you actually run all 3 of those, you tend to cut out a lot of constituents, especially when you also layer on liquidity, which is extremely important to us, and I'll talk about that later. We get to a minimum criteria of around 1,000 companies. Then we use more ad hoc screens to whittle that down into a kind of rough investable universe of around 400. And these ad hoc screens might be, we're looking for companies where there's been recent management change. We might be looking for companies with parent subsidiary buy-in potential. We might be looking for companies or financials with strong balance sheets. You need to look at different metrics to industrials, for example. So some of them are thematic, some of them are more, longer term thinking. But essentially we have a bunch of these ad hoc screens that take out a further 600. From that 400, getting down to the watch list of 100, which is quite actively monitored, is a combination of all things. We meet upwards of 150 companies a year between us. We have 20 plus years of company notes to refer to, huge amount of accumulated experience across the team. And we lean heavily on that to identify the most attractive of those 400 to stick onto a watch list. And then from the watch list, we pick out those that are actually more, relevant ideas for now. So we might have a great company on a watch list for 5, 6, 7, 8 years, but it never looks cheap enough. So we never bring it onto the short list. And actually, we've got a few examples of where that was the case until very recently, later on in the presentation. So shortlist is where the really deep bottom-up work, begins. We use investment checklists to keep us honest, to try and minimize any behavioral biases. Of course, we can't eliminate them, but we do our best. And to ensure that we're not cutting any corners in our bottom-up analysis. We are concentrated, we are long-term, therefore it is important to truly understand the companies and do the work ahead of investing. And lastly, we end up with 30 to 40 positions, as I mentioned before, and I'll come on to position sizing slightly later on. So portfolio construction. The table on the right-hand side, you'll see has 3 columns marked: stable yield, dividend growth, and special situations. What are these? Well, these are our own developed sort of internal buckets that we put all of our holdings into. Now, given the nature of the trust and everything I've said so far, I hope you'll assume that the vast majority of our companies will be in this dividend growth category. So that is companies that have a 5-year plus track record of growing dividends. And this is in addition to the attributes that I told you earlier that we're looking for in terms of financial soundness, growth, and shareholder returns. And as you can see, the portfolio weight typically of dividend growth companies is sort of 60 to 80%. But if we were to restrict ourselves purely to those kind of investments, we would, I suppose, miss out on many other exciting criteria-led investing in Japan, and stable yield and special situations are designed to capture those. So if I start with stable yield, this might be a company that, for whatever reason, it might be a product cycle, it could be the macro environment, it could be anything, hasn't been able to grow its dividends over the last 5 years, but has been able to defend the dividend through hard times. And for whatever reason, we believe that that cycle is looking to move through going forward. And once that product cycle reverses or the macro conditions improve, this company will get back to strong earnings growth and dividend growth in the future. So that is what stable yield is designed to capture, those good companies that are defending themselves through hard times, but with a positive and improving outlook, and that we would believe will move into dividend growth over time. Special situations, this is slightly more of a catch-all, but this is designed to be able to take advantage of fast changing opportunities in Japan, of which there are many thanks to the corporate governance revolution. So actually today's, portion of the portfolio in special situations is considerably higher than guidance at launch. And that just reflects what's going on in Japan. So an example of this might be a brand new CEO joins the company. For the past 30 years, it's been run by the same family in a conservative way with no attitude towards entertaining shareholder returns or indeed minority shareholders at all. So that new CEO could be the catalyst to completely change the outlook of the business and the corporate governance of the business. And we want to be able to invest in those companies that have changed and changed fast and not hamstring ourselves by requiring 5-year track records. So as I mentioned, we are concentrated, minimum 2% position size, and liquidity is at the forefront of our minds whenever we make these decisions. Yes, we are a trust. We have the benefit of sort of semi-permanent capital, but we do not. That does not give us an excuse to reduce liquidity to worrying levels. So over 95% of the portfolio could be sold within a week, and we want to make that quite clear. So moving on to portfolio, I will take. I have 2 examples here: SMC and on the next slide, Kientz. But they are 2 sides of a similar coin, so I will talk to them together. But to give you an example of the kind of company that we've recently bought into the trust, both positions are new as of 2026. So these are both incredibly high quality companies, SMC and Kientz, and have actually historically always been a bit too expensive in our mind to be considered in this strategy. But over the last 5 years, quality companies have been derated considerably, and many of which have actually, like Kientz, for example, continued to grow their earnings, but have just received a different view from the market and a different valuation. So for the first time in a while, high quality companies that have always been too expensive are looking accessible for the trust. And that's pretty exciting. And these are 2 examples, and both of which actually have had management change in the last few years. Again, another catalyst that we look for some of these fast changing businesses. And Kientz in particular, on the next slide here, if you look at the bottom left, you can see the dividend profile. The dividends have more than doubled in the last 5 years from a low base, albeit admittedly. But this new president, who has only been in place for a few months, has a more constructive attitude towards shareholder returns. So that really fits the bill of dividend growth company, even if not high yielding today. So where are we positioned at the moment? These are the top 10. I won't go through them, but of course, feel free to ask anything about them in the Q&A. But I point you perhaps to the sectors. We are very mindful of being overly exposed to any one end market or end customer. We think in those terms rather than purely in sector definitions. I think many of the definitions are very stale. But the point being that you won't wake up tomorrow and find that we've got 60% in banks. We want to be diversified. Yes, we hold between 35 or 30 and 40 holdings, but it's how different those holdings are that matters more than how many different holdings. So just please be, confident that the consistency in the return profile is what we're aiming for, and therefore that we're very mindful of end market exposure. And on a single stock basis, as you can see, there's nothing above 6.1% today. That's pretty typical. Nothing's crept above 8% on a geared basis, or indeed really 7% on a flat basis. So think of the top 10 of representing around 50% being quite representative. Portfolio characteristics. I think this is a really key slide to try and convince you that we practice what we preach. So if we look at the portfolio statistics as compared to the TOPIX or the Japanese equity benchmark, you can see that the trust is trading at a slight price to book premium versus the market, but we would argue for commensurately higher return on equity, or ROE, which is the next one down, and higher book value per share growth, we would argue, than the market. And actually that the price to earnings multiple is lower than the TOPIX today. So what we're saying here is that you're paying around market multiples for higher returning and higher growth businesses, we would argue. The next three, the margin profile, gross profit margin. This is extremely important to us. This is a good indication of the pricing power of a business. And you can see that it is considerably higher than the benchmark. And we believe going into an inflationary environment in Japan, we need to be really careful what we own. For a long time in a deflationary environment, it hasn't mattered really whether you sold a commoditized product or a value-added product. In an inflationary environment, wage inflation taking hold, input cost inflation, you need to invest in companies, we believe, that can pass through those cost inflation headwinds to customers. And those are customers with often with high and stable gross profit margins. Of late, there's been quite a considerable valuation uplift for lower quality stocks. We would caution whether or not that is sustainable in an inflationary environment going forward. And finally, the bottom three of rows of the table, we think you're getting higher quality companies at market multiples with high growth prospects, but they're also yielding higher free cash flow at 5.1% versus the benchmark at 4.7%, and indeed a higher dividend yield at 2.3 versus 1.9. It's worth just noting that dividend yield is ungeared and to the NAV. So share price yield will be higher than that. And the active share at 80% shows the point about us earlier being non-benchmark or benchmark agnostic. Bottom right shows we have a decent holding in smaller mid-cap, and that is very important. Again, like I've said, it's a great place to be an all-cap investor in Japan. This very simply is a sort of proof point again of our average holding period of around 5 years. And actually, if you look to the right-hand side, you can see that there are some holdings, well, there's 36% of holdings that actually have been held for more than 7 years, and 11% of holdings have been held for the life of the trust, or more than 10 years. I'll skip over portfolio activity for now, but of course we can come back to it. Dividend. This is extremely important. So we're very pleased that the underlying assets and indeed the board who decide the dividend have been able to produce this kind of smooth and consistently growing profile through the life of the trust. If this continues next year, which we would very much hope that it would, we will hit the next generation dividend heroes of the AIC. But I'd like to just point out also that there is a reserve built up, that the in fact, the dividends are not paid out of capital, and in fact, a dividend reserve has built up over the years. And this is despite the fact that there's been a currency headwind in terms of the yen weakening over that time frame. So we think an impressive dividend growth profile, all things considered. Performance. Again, very, very pleased to say that it's meaningfully outperformed over the years. The consistency point I want to make here is just that if you look at the sort of market conditions from launch until COVID, that was very much a growth market, and the trust outperformed. And then post-COVID, it has been very much a value market, and again, the trust has outperformed. So this is exactly what Richard designed the strategy to do, and indeed what we try to achieve each year, which is that no matter what the swings in or what's in vogue, or whichever style is driving returns in Japan, we want to be participating in the upside and continuing to stick to what we do and produce a consistent total shareholder return. This is another way of cutting the same thing, so you can look at the consistency by year. But this is the final slide. So just to reiterate, and actually to add an additional point, which is the prior 10 years, corporate Japan has produced very strong returns. And in fact, corporate Japan in local currency has produced higher earnings per share growth since the beginning of 2013 than even the US. That may be very surprising to hear, but this is how good corporate Japan has been able to perform despite having a bunch of macro market and other headwinds during that time frame. Our argument is that these headwinds are now at least neutral, if not tailwinds. So imagine what the market can achieve with the wind at its back. And we believe Chikara CCJI is set to benefit from exactly these kinds of trends as it did from launch, but they are as relevant and even more exciting from today. So thank you very much for listening, and take any questions from here.
That's great, Theo. Thank you very much indeed for updating investors. And Nicholas, I'll bring your camera and microphone back up. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the right-hand corner of the screen. But before we go into the Q&A session, I'd just like to remind you a recording of this presentation, along with a copy of the slides and the published Q&A, will be available via your Investor Meet Company dashboard. Nicholas, if I may be so bold to ask you just to manage us through the Q&A. Thank you to everybody for your engagement this afternoon. A number of questions there. So over to you, Nicholas, and I'll pick up from you at the end.
Brilliant. Thank you very much, Mark. And thanks, Theo, for that pretty comprehensive presentation there. I think a few of the questions have probably been answered within. But what we have here, let's start with maybe quite a hard question, but everything about Japan seems to be extreme. Currency relentlessly falling, bond markets dominated by government buying, debt high, but mostly Japanese owned, interest rates suppressed to encourage inflation and keep debt repayment low, etc. Extreme situations lead to extreme outcomes, good and bad. But this a viewer said they're unsure of which way. But can you comment on some of these factors and how they might affect the trust and your stock choices ultimately?
Yeah, I think quite a lot to unpack there. I think to start with, this change to inflation is extraordinarily important for almost all of the things that you have mentioned. And part of the reason the yen has perhaps performed as it has been the sort of the importing of inflation as well. So these are all linked. But the change in attitudes level and indeed at a retail level in terms of adapting to an inflationary market are really, I guess they haven't been seen for 30 to 40 years. So, this rise in inflation is extremely important, not only for companies to kind of raise standards, to shake out those sort of zombie companies that shouldn't have existed for so long, promote wage growth, promote labor motility, like all of these things are all linked, and we think on the up, very importantly. To your point about debt, so and you did mention that point out that it's very much largely Japanese owned, the debt market, but net debt to GDP is 100 percentage points better than gross debt to GDP. And I think it's finally, the asset side of the equation is finally being appreciated a bit by international investors. It's one of the few places that is expected to actually reduce its net debt to GDP number over the next 4 or 5 years. That same cannot be said of many other developed markets globally. So yes, it is in the situation it's in, but it is on an improving path. And inflation is good both for inflating away the debt on the top of the fraction, but also for promoting GDP growth on the bottom. When you also layer on Takaichi-san, the female prime minister, who's very pro-growth, we think actually the outlook for that side of things is pretty constructive for Japan. Thank you.
Absolutely. An interesting question here about the relative size of the team compared to perhaps some other investment houses. Where do you think you have your edge, I guess, and your competitive advantage relative to these bigger teams? They noted that you have had excellent performance as well. The track record speaks for itself. The discounts remain relatively tight. So yeah, where do you think you have that edge? And just leading on from another question as well, about how you spoke about engaging with management and stuff, but how far you were able to go into that and kind of influence management, I guess, and advise them on their future movements?
Yeah, thank you. So, I said specifically already about I think some of the benefits of being a small team. So I won't go over them again, but with that, bear that in mind during the answer. I think that is really, really important. I think these large teams can get stuck in committee level thinking. I've been part of a larger team myself and have certainly recognized that in the past, and Richard the same at JP Morgan, etc. So there are definitely benefits to being small and agile. In terms of where you think you have your edge, I think edge is overused. I think that it's actually very simple to put together what is sort of essentially a rigorous investment process. The really hard thing is sticking to it. So I think that's where we've been consistent over time. And again, it's that word consistency. I'd say not all investors could say that they haven't had any sort of style drift over the last 10 years other than Richard. So it is sticking to our guns, keeping each other honest, doing as best as we can to kind of control behavioral bias. That's really where I think outperformance truly comes. Of course, you need to do all the other minimum standards of strong analysis of companies, discipline, etc. But I think really sticking to your process is probably where you get the most reward versus many others.
Mm-hmm. Yeah, that makes sense. A question on the concentration of the portfolio. Having 35 holdings is obviously relatively concentrated, particularly versus kind of index passive, more passive strategies, I guess. How are you managing stock-specific risk within the portfolio?
Yeah, it's a good question. Risk is extremely important. On the diversification point, actually, it's quite interesting. Like many studies show that really beyond 20 to 25 holdings, the mathematical kind of argument for diversification, for adding more holdings, it really depletes quite quickly. My point being that actually quite often a 60 holdings is no more actually diversified in terms of end risk than 30 or 35. That being said, it's the sum, by far the biggest risk of the portfolio is the sum of the stock specific risk in a concentrated portfolio, as the question alludes to. So how do we control it? Mainly through the work that we do before investing, and indeed, once we've invested. It's really not as simple as that, but I think that is key. It's just, again, being disciplined in what you're buying, knowing what you're buying truly, and then worrying about end of market concentration as and when it's sort of position sizing comes into it. Of course, then also on top of that are the kind of limits that we impose in terms of single stock, maximum percentage holding. We actually haven't really tested the 25 that we could technically hold in the trust. We haven't gone as concentrated as that. And again, that's recognizing the fact that we don't want, we can always be wrong, right? So we want to manage the fact that we don't have 10, 12% in one holding. So you can be sort of assured that that won't change over time. We're all very aligned in that.
You've probably answered this in bits and pieces, but maybe just to wrap it into one question: what structural changes in Japan might actually impact the performance of the trust? And I suppose also you could include how sustainable is the rising dividend track record through different market cycles. I guess that may be relating to some uncertainty within the markets at the minute and geopolitics, etc. Moving forward.
Yeah, I'll take the second one first, if I may. So I think, of course, the dividend is decided by the board, but of course is heavily influenced by the dividends produced by the underlying holdings. What I would say is that the life of the trust, albeit 10, 11 years, has seen a lot of varying conditions already. So it's seen big swings in, I guess, style from an equity point of view, but also we've had negative interest rates, we've had positive interest rates, we've had deflation, we've now got inflation. We've had periods of sharply appreciating yen, we've had periods of sharply depreciating yen. And the trust is not hedged, right? These are Japanese assets, but the dividends are paid in GBP. So even despite that, and especially despite the yen depreciating, the board has been able to protect the rising dividend shape and also build up a reserve. So were the yen to strengthen, all else being equal, it would actually be a tailwind for the dividend on the trust. So we can never promise anything, of course, and nor can the board, but the intention very much is to attempt to continue to be consistently growing dividends to shareholders. And the first question, Nicholas, can you just quickly remind me what that was?
Yeah. So what structural changes in Japan do you think might impact the performance?
Yeah. I mean, the biggest two for sure are inflation and therefore interest rates, and the corporate governance revolution. I truly think Japan has a Japan-specific, case to it beyond everything we've all said. If at a time where global equities are at all-time highs, I think you need to have something more than just beta to be an attractive asset for allocation purposes. And Japan really is that. There's so much more self-help that can come both in terms of balance sheet, margins. You only have to look to how many private equity funds have set up in Japan and how excited they are about Japan, because their 7-year time horizon is aligned with ours. The opportunity for the kind of diligent investor in Japan, both in private and public markets, is unparalleled, I think, in any other sort of large and deep and liquid market globally.
Brilliant. Just to comment on the dividend questions and the dividend topic, we did have a few questions that were pre-submitted, and I think it would be more appropriate for us to speak to the board following this webinar, and we'll try and respond to as many of those as we can as appropriate after the webinar. I think I can see time's ticking on a little bit. Maybe one final question with regards to the portfolio's exposure to the domestic economic growth as opposed to more globally. And also, I guess, maybe you could touch on the aging population in Japan and the impact that may have on the portfolio and the stock selection process, I suppose.
Yeah, sure. So global, domestic, and then aging. So take the global domestic thing to start with. I think, we are active and we move around. So for some time, the consumer in Japan is under pressure, one of the results of inflation. And so, for example, domestic retailers have had a really, really tough time. And it actually goes on to the aging population question and the labor shortage. So there are currently 8 open jobs per applicant for food preparation jobs in Japan, right? So, yes, this is driving wage growth, good overall for Japan, for sure. But there are pockets where companies can't find sufficient labor. And then when you couple that with input cost inflation, these companies are selectively in trouble. So, we don't have domestic retail, for example, at the moment. That's not to say we won't going forward. And actually, in fact, some of the more domestic-oriented companies, the valuations are looking much more attractive. If you're selective, as we say, in terms of looking for companies with pricing power, then it's less of a problem that there's fewer candidates to go after, because they're the ones who can afford to hire them. So I think I'd say that, at the moment we're probably, 60-40 in terms of international to domestic, but that could easily shift if we find, continue to find attractive opportunities in domestic growth economy. I think it's been shown that Japanese GDP doesn't always doesn't define the earnings growth that corporate Japan can produce. Just look at the last 10 years. It's been fantastic, and GDP growth has been poor. So they're not one and the same. I think, John, a quick thing on aging population. I think just to highlight there, it's nothing new. That's not to belittle it as a factor. It's extremely important, and we consider it in everything that we do. But it's been 20 years since the population peaked, almost, and it's been 30 odd since the government's been priming everyone for this. So this is nothing new, and it's forced. It's probably no coincidence that some of the best robotics and automation companies are in Japan. So again, you've got to be selective here, but a lot of these companies have been very well prepared for this. And actually, in fact, as the rest of the world follows on the path that Japan is already far along, it's not inconceivable that some of these companies are able to export their expertise and services to other nations over time.
Brilliant. Thanks, Theo. I can't see any more questions coming through. Mark?
That's great, Nicholas. Thank you very much indeed for taking us through the Q&A. Theo, I'm shortly going to end the webinar and send those on the call to give you their feedback, their thoughts and expectations. But I guess before doing so, I wondered if I may just come back to you, Theo, for one more time, just to ask you for a couple of closing comments. And then, as I said, I'll send investors for feedback.
Great. Yeah, thank you. I suppose, what I'd like to leave you with is that there is a genuine Japan-specific story here, and it is the same one that the trust was designed to benefit from 10 years ago. The market as a whole has done extremely well, and I think we should caution. You should probably have caution in what you own in Japan. I think it's going to become even more important as inflation embeds itself, the bifurcation of performance of companies. So absolutely, Japan is a great place to invest for structural growth. I think you just need to be a little bit mindful of what you own going forward. So we would, of course, being very biased, argue for an active strategy, or indeed our own.
That's great. Nicholas, Theo, thank you once again for your time this afternoon. Can I please ask investors not to close this session, as we now automatically redirect you so you can provide your feedback in order that the company can really better understand your views and expectations. This will only take a couple of moments to complete, but I'm sure will be greatly valued by the trust. On behalf of the team from CC Japan Income and Growth Trust PLC, thank you for your time this afternoon. We wish you all a good rest of your day.